classes. As you know that we have already completed the first two components of this chapter, inventory valuation. So today we'll be starting with the third part, that is inventory record systems, periodic and perpetual. Now in the inventory record systems, there are two ways to record the inventories, periodic and perpetual. So let us take these one by one. Now starting with periodic inventory system. Now before we go into the definition, let us just pause for a minute and just see what it means. A periodic system, as the name tells you, it means it's a system of inventory recording on periodic basis. The period can be a counting year, that can be a quarter, that can be 6 months. But the essence of the system is that at the end of the period, inventories should be calculated or measured. Now, this is a very simple technique of inventory measurement. Now, if as a manager, you want to know inventories available in your stores, how will you do this at the end of a particular period? The very basic thing is that you can go to the stores and you can measure all the inventory, you can count all the inventories. So after counting of the inventories, multiply this with the pricing. The price of inventory can be cost or market price, whichever is least. So multiplying quantities with the cost will give you the value of inventory, and this is what this system is. Periodic inventory system, that is valuation of inventories or recording of the inventories at the end of a particular period through physical count. So this is also referred as a system of physical stock taking or physical inventory system. So this system involves physical count of all the items of inventory at specific intervals. Now that interval can be a year, that can be 6 months, etc. Now, this is also known as physical stock taking system, and the system updates the inventory records from time to time only after the physical count. This is what you might have seen in your 11th class final account chapter. Like you have opening stock given in the trial balance. That means that throughout the year, the stock which you are having, it remains same. Reason being that you are not counting or recording the inventories throughout the year. So all purchases are recorded in the purchase account, sales are recorded in the sales account, and your stock remains same. Then at the end of the year, when the year is over, you measure the inventories as per physical count, and then the closing stock comes into the picture. And that closing stock is given as an additional information. So under this system, the steps will be that during the particular accounting period, all stock purchases are tracked through the purchase invoices. So you have invoices, you have purchase book and purchase account, you can count the inventories. Then at the end of the period, quantities will be measured through the system of physical stock taking. You might have seen this system being working in real life also when you go to some shop to buy something, and on that shop the shutter is down and a notice is there which says that stock taking going on. So they are counting the stocks. Obviously, during stock taking, one should not disturb the stocks if you want to have the actual calculation or the measurement of the stocks. So the stock is measured or counted at the end of the period. Then quantity so measured will be multiplied with the price, of course, as per the methods. So here comes the pricing methods also, because inventories are to be measured at cost or market price, as the system says, LCM rule says, whichever is least. But what is the cost and what is the market price? So there are various methods to determine the cost price and the market price. So according to the valuation method that you will be using, you multiply the quantity with the price. So we use the term price. So price is neither cost nor market. It is the price as per the pricing method. So that will be considered and you will get closing stock. So what will be the cost of goods sold in this case? So this method is working on the assumption that if the stocks are not traceable in the stores, if you do not find something in the stores, it will be sold. It must have been sold. So cost of goods sold is calculated using the formula cost of goods sold is equal to opening stock plus purchases minus closing stock. Or what else can be done is you can calculate units sold. That will be units in the opening stock plus units purchased minus units in the closing stock. And then multiply this with the prices as per the method. That will also give you cost of goods sold. So basically under this system, what we are doing is we are measuring closing inventories first and valuing them, and then cost of goods sold comes to be the balancing figure. That is, if something is not there in the stores, if something is not left as a closing stock, it must have been sold. That is what we are saying. Units sold can be measured and then multiplied with the prices. So let us understand this with the help of a very simple example. So ABC Limited had a balance of 6,000 units of stocks of 10 rupees each in the beginning. Okay, so this is your stock available in the beginning, and then during the year 2019-20, the sales and purchases are given. So purchases are given and then closing stock is measured. So sales are not given, only purchase is available. So we are to find out the value of closing stock. Since selling price is 16 and we are assuming we are having equal cost price for all the lots. So you can say that your cost price will be the pricing base because cost price is least. Although, in reality, when we are working for the complete year, we might not be having same cost coming here throughout the year. Okay, so it may be 10 rupees at some time, it may be 9.5, it may be 10.5, and maybe if the prices have increased, it may be 11, 12, or something like this. So we have a flow of costs during the year, and that is why the methods of inventory valuation comes into picture. So if you have, say, 10 rupees, 11 rupees, 12 rupees of lots, then this closing stock of 800 units, it will be from which lot? From first, second, or third. So there in the methods of inventory calculation or inventory valuation comes into the picture. But right now what we are studying is the system. So throughout the year you just have purchases invoices with you, and you have the selling price of 16. You are left with 800 units. It means your closing stock will be 800 units into the cost price, that is 10 rupees, and units sold will be measured as opening units, that is 1000 units, plus your purchases, isn't it? So these are your purchases. So you have opening units here plus units purchased minus units left in the closing stock. So closing stock will be 1000 plus 1400 minus 800, that is 600 units. So that can be measured. So herein your closing stock is 800 units. So it will be 800 into 10 rupees, which is the cost, as it is lesser than market price. So 8,000 rupees is the value of closing stock. Now units sold will be opening stock plus purchases minus closing stock in units. That gives you 1600 units, that you can see here in the question also. You have an opening balance of 1000, and you have purchases of 500 plus 400 plus 500, and you are left with 800 units. Okay, so that gives you 1600 units as sold. So cost of goods sold will be 1600 as per the pricing method, 10 rupees. So 16,000 rupees will be the cost of goods sold. Whereas profit will be measured as sales minus cost of goods sold. So sales will be, you are selling 1600 units at the rate of 16 minus cost of goods sold. So profit is 9600. Now this cost of goods sold can also be measured in a different manner, which will be opening stock of 1000 units at the rate of 10, that is 10,000 rupees, plus all the purchases and minus this closing stock of 8,000 rupees. Okay. Now the basic advantages of this system are that it is a accurate system, because whatever inventory you are stating is actually there in the stores. So it will give you the accurate amount of inventories, and it is less expensive because usually at the time of stock taking you will close your shops for some time and then you employ the same staff that you are having for the measurement of inventory. So as such, not much cost is involved. However, the hidden cost is a lot, because when you are closing your shop, it will imply that your customers might be coming, but you are not in a position to make sales. So you will be losing customers, you will be losing business. So maybe if a person comes to your shop and doesn't get the stocks, he might not come again. He may go to some other shop. So you are losing business. So the indirect cost of this method is a lot. Okay, although directly cost is very less. Now it's a time consuming process. It affects your regular business, of course, because at that time you are closing your shops. Then losses of the stocks are wrongly included in the cost of goods sold. Since in this system there is no way to determine losses, reason being your cost of goods sold is the balancing figure, isn't it? Because cost of goods sold is taken as opening stock plus purchases minus closing stock, assuming if some stock is not there in the stores, it must have been sold. So you are having no scope for determination of the stock losses. So what actually happens is that your losses are indirectly included in the cost of goods sold. Okay, now next is no stock information for interim reports. Obviously, in fact, for annual reports, you are shutting down your business, you are closing your business for some time. And if you want to have the same information again and again for different time periods, maybe quarterly or 6 monthly, then this is not feasible. You cannot close your shop more often, isn't it? So no information will be available for interim reports. So these are some of the limitations. Again, we cannot find out the losses here, although you can take some steps to find out the losses. Like what you can do here is that you can take stock of the units sold, then compare it with the actual units sold here, and then you can find out if there is a loss of stock or not. But otherwise, the losses will remain unnoticed, undetected. So we have this another disadvantage or drawback of this system. Now, next system is perpetual inventory system. The term perpetual here means continuous. That is, you are continuously valuing or measuring your inventories. Now, how can we do this continuously? If you want to determine some information on a regular or continuous basis, it means you need to keep a record. So in this system, continuous records of inventory ins and inventory outs are kept in the form of stores or stock ledger. So what happens exactly in this system is that you prepare a stock ledger, and in that ledger, information regarding purchase and sale of stock is kept on regular basis for each and every individual item of stock. So what we say here is that every movement of stocks will be recorded, right? So herein a stock ledger is maintained and every movement of stock is recorded therein, be it stock incoming on account of purchase or outgoing on account of sales. So when you have maintained a register, so information is available on real time basis. Anytime, any day you can get the information. So it is very easy to uh, prepare interim reports. So this system allows you to prepare reports on quarterly basis, on monthly basis. Furthermore, you have information, so you can manage your inventories well. You don't need to base your decisions on your gut that now we should buy the stocks. You can easily look at the store's register, or you can set up a system that if your closing stock goes below this much limit, then we should go for purchase, right? So this system is not only helpful in uh, keeping a record and making interim reports. This system also helps you in managing your inventories well, because you won't be having a situation of shortage of stock or stock surplus, because you won't buy more and you won't keep less, because whenever stock goes below a certain limit, you will certainly go for purchase. So this is how the stock ledger seems. This is the format. So date and serial number is recorded. Then you have here the details. Then you have stock-ins. In stock-ins, you will be recording stock quantity. Then the pricing. Price here does not imply selling price. It basically means the pricing of the stocks. It is cost price for purchases because we know that stock is purchased at a price that is cost price, and it is the method that is cost or market price, whichever is least in case of stock outs. So the purpose of making this stock out column is to find out cost of goods sold, that is the pricing of the stocks which are moving out. So it in no way tells us selling price, otherwise we could have written it sales. So it is not sales, it is stock out. So quantity which you are selling or you are sending multiplied with the price, that is the cost price or the market price, whichever is least. Then within the cost price we'll be having a variety of methods again. Okay, now amount, and then the system updates the balance. So immediately after purchasing of the stocks, your balance will be added, and after every sale or stock out, you will be reducing the balance. So anytime you can see this register and it will give you the balance. Furthermore, if you're say you set a limit that whenever balance falls below say 500 units, a message should come to you. So if you are doing it manually, then your store's manager will be sending you information, or you can order him to place the order for purchase of inventories. So inventory management is also a part of this. Now the steps will be: inventories purchased are recorded in the stock in column with the quantity, purchase price and cost. For every sale, quantities are issued, are recorded and multiplied with the price as per the pricing method. Right. Then finally ledger is updated. So can you identify the basic assumption here? Now here in the balancing figure is your closing stock, isn't it? You update the balance. It means if something is not sold, then it must be there in the stores. So this is your assumption. So this also gives us a problem, because you are assuming, they say you purchased 1,000 units, then you sold 800 units, so you are assuming 200 must be there in the stores. But if suppose some of the stock is lost due to pilferage, okay, so some of the stock is stolen by the employees or by the customers, or maybe it is just broken, and someone has got rid of that, you won't be in a position to find out the losses, right? Although this system still provides you a way to find out the losses, because at the end of a year you can always calculate your measure your actual closing stock, then compare that with the stock coming in the store's ledger, and you can find out closing stock. So closing stock herein is the balancing figure. Okay, this is the balancing figure, right? Now the basic assumption is that if some stock is not sold or issued, it must be there in the stores. So stock losses gets included in the closing stock. Now checking of stock losses, there is no system, but one can compare closing stock with the actual stock which is available, right, to determine the stock losses. Now again a simple example. So herein we will be keeping track of purchases as well as sales. In physical system we are just keeping track of purchases, but herein since we are to record everything, so it will be taken up for the purchase and sale both. Again you can find out here that the cost price is 10 rupees, right? And selling price is 16. So cost or market price, whichever is least. So cost is least, so your pricing method will be cost. So this is how your stock ledger will be prepared. So initially you have a balance, so it will come in the balance column. Now next transaction you can easily see here. This is sale. So you have sold 200 units. This will be recorded in the stock out column. Now what will be the pricing? Pricing is cost price, since you have only one lot available. So it implies this will be the price, 10 rupees. So you will price it at 10 rupees. So your cost of goods sold, stock out, is 200 units at the rate of 10. So your balance is 800 units. Next again you are purchasing. So now after every purchase the balance will be updated. Since the two lots are same, this lot is also 10 rupees. This lot is also of 10 rupees. I have taken this as a simple example just to explain the working of the stock ledger, right? In reality your questions won't be having same cost price, the prices will be fluctuating, which happens actually in the real life. So therein you will have to keep track of the lots. This is your first lot of 10 rupees, this is your next lot of maybe 9 rupees or 11 rupees. So accordingly you will be recording balances here. But right now we can club it because we have the lots of same prices. So 1300 rupees units of 10 rupees. Next again you purchased 400 units. So you can keep track of question here. Okay, so now again the lot will be 1700 units of 10 rupees. Now you are selling 900 units. Since your lot is having cost price of 10 rupees only, so you can directly take here 10 rupees. However, the real problem arises when we do not have 10 here. We have prices 10, 9, 8, 7, 11, 12 coming. Then we'll have to see which cost should be applied. Of course, cost is less than market price. Cost is to be applied, but should it be 10? Should it be 9? Should it be 11 or something else? And therein the methods of inventory valuation, that is FIFO, LIFO and weighted average, that we'll be studying later on, will come into the picture. Okay, so your balance is this much. Now out of 1700 units, if you have sold 900 units, you are left with 800 units. Okay, now again you are selling 200 units, so pricing is same. So out of 800 units you have sold 200 units, so you are left with 600 units. Next is purchase of 500 units. So you have initial lot of 600 units of 10, you have another lot of 500 units of 10. That means your total is now 1100 units at 10 rupees. Okay, it's a simple question because we want to see the working of the stock ledger. Now sale 700 units. So if you sell off 700 units out of this, you are left with 400 units here. So this is your closing stock. So in your stock ledger, you can highlight this as closing stock. So your totals will highlight you purchases and cost of goods sold. Since this was the total of stock in, it means your total purchases should be 1400 units of 10 rupees at 14,000, and you can compare it with the purchase invoices. You can compare it with the purchase account to see whether your total inventories purchased have actually reached your stores or not. Right? So you can control your stock losses, you can manage your stocks. And herein you can also see by comparing it that stocks reached your store on 25th of April. So what was the actual purchase date? Suppose you purchased or you placed an order for the same on 20th of April. It means it takes 5 days to reach the stocks to the stores. So you can check, is it a normal phenomena or is something happened during this time? So you can manage your inventories. Right? Now this thing, the total of stock out column will give you cost of goods sold. Why? Because this is the cost price of goods being sold. So it is cost of goods sold. So you don't need to apply any other formula. You can directly total up and you can find out cost of goods sold. Now this will again tell you about profitability. Your profit can be calculated directly by deducting this cost of goods sold from the sales. Now you can compare the stock outs also with the sales, and you can manage your systems well, because when you say that your sale moved out of your stores, ye sale of say April 27, it means you sent your stock on this date. Now you can compare it with the actual sales date, and you will be finding that how much time does it take to send the stocks. So you can manage your stocks properly, because for every next sale, if your customer says that we need to get the stock within 1 day or 2 days, then you know that how much time does it actually take, and then you can work accordingly, or you can quicken up the process if a customer wants to, because you know the information, right? That is why I'm saying that this method will help you in inventory control and management. Now there is nothing here because the balance is already there. So nothing for updation. We cannot total it because it is a balancing column. So the system is having a lot of advantages. There is no interruption in the normal course of business. There is no hidden sudden stock out of stock situation, because you always knows the stock. It is easy to control the stock losses. It is easy to check stock irregularities. You can enhance your skills in the inventory management. No need of stock taking as such, of course, in this system. It's easy to prepare reports anytime, no cost involved, and you have a basis for inventory control. But the drawbacks are losses are wrongly included in the closing stock, and it is costly in case of businesses with numerous items of small value, because you will have to employ a lot of persons for inventory records at your stores, right? If you have a lot of inventories, you have a lot of stores, so you will be employing accordingly many persons. So it may be costly, but this cost is worth it. Now let us understand the difference. The first difference is the definition. Now I really appreciate if you can just pause for a minute with each point and think over the difference, and then you look at the point here, like definition. Now, periodic system involves physical count of the inventories at specific intervals. Perpetual system involves system of recording of purchase and sale on continuous basis. Then what is the basis of inventory measurement or closing stock? So in case of physical system, periodic system, it is physically counted. But whereas in case of perpetual system, it's a stock entry. You just look at the entries and get the balance, that is updated balance. Okay, now how to calculate the cost of goods sold? So in periodic system, cost of goods sold is the balancing figure, because you first calculate the cost of closing stock and then you measure cost of goods sold with the formula. Whereas under perpetual system, you have actually valued the stock issues at the time of each issue. So by adding the stock issues, you can determine the cost of goods sold. But it is again a stock entry. Now, inventory control is not at all possible under periodic system. It's not feasible. But yes, under perpetual system, you can control it. You can control inventories, you can manage inventories, you can manage losses of inventories. Now, available of stock information is at regular intervals in case of periodic system, though in perpetual system, it is available on continuous basis. Now, next point is which system is more accurate? Now, we can say that periodic system is more accurate because when you say closing stock, then it is the actual closing stock there in the stores. You have actually counted it. So there is no point of having a wrong information. Although perpetual system will be less accurate because the inventories shown here might not be actually available in the stores, because you might have some stock losses which are inherently becoming part of your closing stock. It's simple and less expensive in case of periodic system, but in perpetual system it is comparatively more costly. Stock losses gets included in the cost of goods sold, and in case of perpetual system it is in the closing stock. Periodic reports, of course, not feasible here in the periodic system, but yes, under perpetual system, these are always available. You can see the irony here. It's a periodic system, but you cannot have more frequent reports. Okay, periodic reports basically means frequent reporting. Now, inventory management is not possible here under periodic system, but it is there in perpetual system. Effect on business operations is there in case of periodic system because you have physical count through stock taking, but perpetual system doesn't affect your business operations. Someone is there in the stores who is keeping record of everything, so business operations are not affected. So which one will be suitable? In reality, both methods are having their own plus and minus, and if you want to have benefit of both, then it is advised that we should follow both the systems in tandem. That is, throughout the year keep track of inventories through the inventory registers in perpetual system. Then at the end of 1 year or maybe 2 years, calculate your inventories through physical stock, so that you know the situation of stock losses also. So to get benefits of both the systems, apply them both. Although one may say that it will become more costly because you are applying both the systems, but that cost is worth it, because when you look at the real business scenarios, you will be finding that there are many kinds of inventory losses. And in order to manage the inventories, in order to have proper system of purchase and sale of inventories and reporting of losses, it is appropriate that you follow both the systems, and this cost is really worth it. It's really worth it. Okay, so this is how we can explain which method is suitable. So we should follow both the methods. They are complementary to each other. Okay, they are not substitutes actually. They complement each other. Something which is missing in one is supplied by the other method. So both should be followed. Now, through this, although these are not the examination questions, but these are some of the questions which you should think about whether you have understood or not. Number one is how loss of stock gets included in cost of goods sold or closing stock. This, I think, it should be clear to you through the two methods. Next is calculation of cost of goods sold and gross profit. I hope this is known to you. Now, what is so strange in this question? The strange part was that this was having same cost price as I explained in the example also. The cost price is same, which is not reality. In real, the cost price is going to be different. It's not that the cost keeps on changing. But when we purchase stocks in lots, then depending upon our lot also, the price keeps changing. If you buy more quantities, you are offered discounts, trade discount, etc. So the price automatically falls down, isn't it? So in reality, the prices will be different. We will not be having one cost, we'll be having a flow of costs. And that brings us to the next part of this chapter, that is inventory methods, valuation methods. FIFO, LIFO, and WAVE, these are the three main methods that we'll be studying. And the reason or the need for these methods is because of the cost flow. We have a variety of costs and which one should be considered. Obviously, we need to have a system to decide that. It should not be arbitrary. Otherwise, you will give rise to a fluctuation or differences in the profits. If you want to have more profit, apply one method. If you want to show less profit, apply another method. So we should not have this kind of discrepancy, or this thing should not be there in the hands of the business, because then you can window dress your accounts, and which is not a right policy. So we should show fair prices of the inventories, and for that method, objective methods have been designed. So next time we'll be studying those methods. All right. So meanwhile, you can understand these and prepare a note on these two methods. It's important question for theory. So stay learning and practicing. Keep smiling. Thank you.